Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Kate Campbell, welcome to this Australian Finance podcast.
It is wonderful to be back, Owen.
What are we talking about?
We are talking about all the things we've learned from our share investing journey. We did an episode a few months back in 2024 about all the lessons we've learned during our ETF investing journey, and it was really popular. So I figured we should do the same for our share investing lessons. They're a little bit different because share investing is quite the roller coaster.
Yes, it can be. ETFs can be as well, but typically not as much of a roller coaster. Kind of like the child's version of the roller coaster, if you will.
Yeah, and I mean, it depends if you're in your core ETFs or you're getting excited with some thematic ones.
Yeah, it does indeed. But we are starting to see more new investors start with ETFs, which makes a lot of sense. But we're talking about share investing, which is buying individual shares of individual companies. So I'm curious, Kate, what was your first share investment?
I don't know the exact one, but I know one of the first few was a company called Adacel.
Oh, yeah.
Which did the technology for air traffic control training simulation systems. Because at the time, I was in the Air Force and I was doing air traffic control training, and I saw that name everywhere.
Oh,
and
right.
Yeah, so that was one of the first investments I made. Now, I say investments should be with air quotes because I wasn't approaching it with an investing mentality. At the time, I was 18. I had some money. I didn't have many expenses because I was living on base. And I just downloaded a brokerage account and I started buying and selling some random, I would now know them as small caps, small companies that are not household names. And I was just sort of buying here, selling here, giving the broker a lot of money because you pay a fee every time you buy and sell. I wasn't really making myself much money. I remember a year or two ago, I found the records from my brokerage account of what happened back in 2016. And I could see all these different buys and sells, and I pretty much came out even. I hadn't made any money after about 100 different transactions, but the broker had made probably at least $1,000.
Wow. So your first investment was looking at the things around you at the time in the Air Force, and you saw this name Adacel, and you tracked it down and you realized that was actually a small cap, a smaller company on the stock exchange. I myself actually owned Adacel on two separate occasions as well, for none of the reasons that you just mentioned. I just thought it was really interesting, and I thought the technology and the software was quite cool because it actually was a really compelling piece of software, because once, in this case, maybe the Air Force started using it, it was really hard for them to give it up, because once you're trained on a system, it's really hard then to get off that, particularly if it's like defense or anything to do with aviation. So different experience with that.
What about you?
Yeah, my first investment was actually National Australia Bank, which we were just reminiscing about. When I started, National Australia Bank shares were around, just looking at the charts here, about $22, $23, around that range. I can't remember exactly. Now, at the time of recording, it is $38.44. So I would have been sitting on a hefty profit had I held for well over 10 years. I also would have received dividends, which I would think, combined with a near 100% increase in the share price, franking credits that National Australia Bank pays with its dividends, and the dividends themselves, which are cash dividends, I reckon it would have been a really good investment. As in, I reckon it would have beaten the market, so to speak. It would have outperformed the ASX 200. But I think I've done better by not holding NAB that whole time. I think I've done a lot better. And I can remember why I bought NAB. I remember getting my first brokerage account, and where it's got like the search box up the top, which is kind of like, for those of you that have never used a online share trading account, it's kind of like the search bar you get on Google, but you just search for companies or ETFs or things to invest in. And you can search by ticker symbol, which is the unique code that identifies each stock or ETF or whatever. I remember just putting in all the businesses that were around me, kind of like what you did. But I started with Microsoft. Oh, that wasn't available. Apple, it's not in there. Facebook, oh, it's not in there. NAB, I walked past a NAB today. Never banked at NAB in my life. Walked past one. I was like, oh, NAB's in there. I'll buy that one. That was the extent of my research because I was just interested in buying something, anything really. The second company that I bought, which was just like a couple of minutes later, diversifying all that, Kate, I bought Telstra. Yeah. And
all the classics.
Let's have a look at Telstra now. These are the two blue chips, if you will, the big companies here in Australia. So not a small cap, as you mentioned, but the blue chips. About that time, Telstra would have been around about $3. I think I remember getting it actually closer to about $2.50, maybe $2.70, let's say. It's now $3.92. But my first two investments, NAB rose really quickly at the time. It rose from like $23 to about $27 really quick. So I was like taken back. It's like 20%. I was like, wow. But Telstra, however, I sold NAB after not too long. But Telstra went from like $2 or $3 all the way up to like $6. And I held it through most of that time. And I was so overconfident. I was like, I'm really good at this. I can pick stocks, that I put my mum's money, who was like, I should do something when my parents separated. I was like, I can help you with that, Mum. I'm really good at this thing called investing. So I'll get your money.
Says 20-year-old, very overconfident.
Yes. I'll get your money and put it in Telstra. And lo and behold, she did actually do well. I think in that original investment, she made about $50. But then I subsequently recommended to her, not financial advice, that we would both invest in Slater & Gordon. And that came a couple of years later, which for those of you that don't know, Slater & Gordon is a law firm that went great guns for a few years and then it just imploded. I did really well out of that, but then I put some of Mum's money in there and she lost a lot. And after that point, it wasn't like, when I say a lot, it wasn't as much as she made on any of the other investments, but it was still meaningful because it was my mum's money. I cared more about her losing money than me. So I took her portfolio and I just put it in a company called ResMed, the healthcare company, and a bunch of different ETFs, which I was learning about at the time. I was like, this seems like a more sensible thing for my mum to do, so she should do it. And that was a much, much, much better outcome. So if you haven't already seen our episode, 10 years of ETF investing, go and check that out on YouTube or in your podcast player, because if I was starting again, that's definitely where I would start.
Yeah, it's interesting you started with 2 dividend shares. We were speaking about dividend shares on the podcast last week, and often they're not the starting point for people these days.
I think, even though I say that people should start in ETFs, and you'd probably say the same thing, the problem with saying that, Kate, is that ETFs are mostly boring.
Yep. So we've even had a comment on YouTube of, why do you only talk about boring stuff?
Well, there you go. And the answer is because boring works in investing. It does. Yeah. But particularly for young men who get into this, or even older men for what it's worth, men in general, sorry guys, we're all on the same, I'm going to lump us all together, but we're not all the same. Typically men need some sort of stimulus. It's like when you go and hang out with your friends on the weekend, there's always that guy that's just more interested in the tennis ball and bouncing the tennis ball around, or like kicking the footy than chit-chatting away about finances, right? So that guy needs something that will get his attention. And typically what that is an exciting new idea. Mm-hmm. It's a breakthrough in technology. It's cryptocurrencies. It's this, that, or the other.
Yes, artificial intelligence, yes. ETFs and stocks at the moment.
So if they do start with ETFs, typically those types of investors start with things like hydrogen or AI ETF if they're going to start with that. So this is the thing, I would fully encourage everyone to go and experiment with those things.
With a small amount of money.
Just a small amount of money. Don't go in heavy because it will most likely not work. And, they say that this is an old male pronoun proverb, but it is the man with no master has a fool for a master, which basically translates to, if you don't learn from the mistakes of other people gone before you, you will forever live your life figuring out the same mistakes that everyone else has made, and you'll just get ordinary results. Instead, you can learn from the mistakes of others and the successes, and one of the things that is a nearly sure way to improve your investing is to start with ETFs in a really humble way. And then sure, go and do that other stuff. If that's what really gets your passion going, the new technology, the new company, absolutely. Like, I wouldn't take back my journey for a second. But I reckon if I just started off with a Vanguard ETF, I would never have gone down this path and I never would have stuck with it the way that I have. So you do need a bit of that, and that's okay. But as we'll discuss in just a moment, there are newer ways to invest. Okay.
The first lesson that I've learned and I wanted to share today is that with share investing, the losses and the gains are magnified compared to going in a core ETF portfolio where I might just be investing in a basket of Australian companies, a basket of US companies, and maybe a few other bits and pieces here and there. That's a very slow and steady approach. Whereas if you're investing in individual companies and maybe you own 5, suddenly one day one's up 20%, one's down 30% because a piece of news came out. You can lose all your money in a company. You can double your money. You can triple your money in a company. And it really gets your emotions involved because there's ups, there's downs, there's things happening all the time. And while you can make a significant amount of money because you've probably heard a friend that says, I've tripled my money with this company, you probably haven't heard the friend also say, I've lost all my money in this company because it went bankrupt, because it did all these silly things or it had some dodgy directors involved or things like that.
Yeah, you don't. You know what people will discover the longer they go through share investing or even ETF investing or any type of investing is that the reason that we call it investing is because occasionally you lose money. There's an old kind of statistic that people like to throw around, myself included, Kate, which is 1 in 5 years, the stock market will experience a market crash on average. On average, that's the average, right? And 1 in 5 of those years will turn into a full-blown kind of like recession type setback. But people don't know that when you pick individual stocks, you're not getting that return. You're getting an individual company's return, which is not the average, which is just what I quoted. It's the ups, the downs, the ups, the downs, the ups, the downs. And there was a fantastic article written quite a while ago by a guy called Ben Carlson out of the US, a fantastic author and investment thinker. And what he found was that the very best companies in the US history were companies like Facebook, Amazon, Booking.com, companies. What else was in that? There's a Priceline. What else was in there? There was companies such as Apple, Microsoft, all these companies. What they all had in common was that all of them, even though they went on to produce fantastic results, were all at one point in time massively down from their recent high, to the extent that some of them were down 80 or 90% from where their share price was. And so there's another really interesting fact is that during the late 90s, early 2000s, Microsoft shares were like the be-all and end-all. .com boom, the internet is here, baby. Microsoft, right? And it was the biggest, best company that people could think of. If you had bought at that time and it subsequently fell when the bubble burst, from memory, off the top of my head, I think it took more than 13 years to get back to that share price. So imagine 13 long years wondering, will Microsoft ever recover? You know, obviously now it has, and it's a wonderful company. It's way bigger than it was then, but that's a long time to wait, Kate.
Yeah.
In the meantime, the stock market was still pedaling up. So a lot of that behavioral stuff, I couldn't agree more.
And there's so many companies that we've both owned and subsequently sold that we look at now and go, if I just left my money in that company and hadn't touched it, or I'd added more money to that company, I'd be significantly more well off than I am right now. But that's the thing, it's hindsight. And we have to make a decision with the information we have at the time. And it is very hard to hold on to a company when it falls 80% because there's been a massive product failure. And it's hard to hold on to that company when it's gone up 100% because it's been doing really well. And you go, well, is this too good to be true? Is this going to last? Should I sell now? And that's, I think, the challenge with share investing, which is quite unique to how we approach ETF investing, because there's so many times that you could sell. You could sell when it's down 50%. You could sell when it's down 20%. You could sell when it's up 50%, 100%, 200%. But with an ETF, the way we approach it's so different now. I find that if we're building our core ETF portfolio where I've got this handful of ETFs and I'm going to be investing in them for 10 plus years, I'm not making lots of decisions about selling. My only decision is, do I have some money to invest this month in this ETF portfolio? And so it takes a lot of the decision making out of it and all those emotions.
It's like, I think a lot of people invest in ETFs on faith. So we invest in ETFs on faith, but we invest in stocks based on science. So what I mean by that is a lot of people, when they invest in stocks, they think they need to know what's the profit, what's the product, what's the service, who's managing it. But when it's an ETF, if you ask someone why they're invested in an ETF, they're like, because over time it probably goes up. No science really. It's more like, well, for the last 100 years, it's done pretty well, so I probably think it will go up again. That's the reality. Obviously, when I invest or when professional investors invest, we invest in a bit more scientific way for sure, but that's the general gist. And that's changed the psyche of an investor. And so we had Glenn James on the show recently. Well, you interviewed him, so I'll let you know what he said. He's the founder of Money, 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 formerly My Millennial Money.
Yep, a few M's in there.
A few M's. Thanks, Glenn. No, but what did he say about investing?
Well, the line that I think you're referring to that stuck with me is investing is easy, staying invested is hard.
Yes. And that's the key, right? So staying invested is hard enough if you just use ETFs, because if I got $1 for every one of our members or investors who wrote into me and said, hey, Owen, you're invested in the US. The US stock market's at an all-time high. Shouldn't we be getting out now? Like if I had $1 for every time someone emailed me that, I would be like retired.
Yeah. Or YouTube comments I saw just the other day. What about the upcoming recession?
Yeah.
But I've seen that every month on YouTube for the last however many years we've been running it for.
Yeah, exactly. So I see that stuff and I think that's the scary part is like people, when they start out with a few $1,000s and they invest or whatever, it's a little bit easier psychologically because it's kind of like, it's just a few grand, I can recover. Then you got $200,000. Then you got $300,000. Now it's $500,000 and you're nearly at retirement. Now things get freaky. So that's where things get hard. But then imagine you didn't have ETFs in your portfolio, those core building blocks, those diversified, don't need to worry about them type things. And you change that for 20 or 30 different individual stocks. Like what's BHP doing? What's the iron ore price up to? They've got a new CFO. Is that a good move? I read this in the AFR today. The company just reported results. Should I be reading those? That is an extra stress that a lot of people don't bank on.
Yeah, that encapsulates the second thing that I've learned from share investing is just there is a lot more to stay on top of. And there's a lot more decisions to make and there's a lot more noise. There is so many articles every day on the large companies that you have in your portfolio, whether they're Australian or international companies, talking about, as you said, what the CFO is doing. Someone stepped down. There's a product recall. They've got this environmental issue that they have to deal with. Oh no, there's a court case that's going to cost tens of millions of dollars. Whereas ETFs, you don't have that to the same level.
No, you don't. And I mean, a lot of people still get scared. That's where having an advisor or investing in a professional
and even just having
helps.
A written investment plan like we've spoken about in the past.
Absolutely. Like just having, like I'm investing in this for this reason. Like every time you make a new investment, not necessarily like a dollar cost average, like I just put some of my money away, but every time you make a new investment, like I'm going to buy this share, write it down. Or I'm going to buy this ETF, write it down. Because then when times do get scary, And that's why when we used to do a lot of our analyst reports for individual shares, like that's what was my career for a very long time, we would always put the risks in and we would make them very prominent. And we would always be very specific over which risks we're worried about because that is investing. If you don't think there's any risk in what you do, you're wrong. Because if that's, again, the longer you go, the more you realize that investing is different to saving money, where there's very little to no risk. In investing, there is always risk. And that is why you are paid more in returns. And I've realized that. Another thing that I've always struggled with, Kate, is just on this is what is a speculative investment and what isn't a speculative investment and how you can think about that. I came across a very elegant way of thinking about this recently. It's like, how do you know what's speculative if I'm taking a more risky bet? The way to think about this is just to ask yourself one question. And it's just to say, when you make an investment, does my investment rely on a future event happening? So for example, if you invest in crypto and you believe it's going to go up, what what is the reason? And if that reason relies on some future event, then it's speculative. If you invest in a company, like say a mining company, and that mining company needs to build a new mine, that's speculative. Contrast that with investing, which is where you know, based on current performance or historical performance, this thing is already doing what it's supposed to. If it's an ETF, it's already owning big stocks and little stocks, producing income. Warren Buffett famously says that if it's an investment, it generates income. And that's probably a fair guide. But my guide is kind of like, does it actually have a product or service that is already in existence? So that would probably be one of my lessons learned.
Yeah. There's such a fine line between investing and it turning into gambling when it comes to share investing specifically, I think. And that's where people can get caught out, because you start looking at investing and saying what you're doing is investing, but you're just throwing darts at a dartboard. You're doing kind of what I was doing at the very beginning, was not really looking at what the company was, what you're investing in, just seeing interesting things here and there and just throwing different darts out there without any plan or strategy. And I think that can get quite dangerous because it can get quite addictive, like every addictive thing, when you just see flashing lights and news and forums and hot stocks and ways to get rich quickly. You can become addicted to just buying and selling different things, and you can take a lot more risk than maybe you should with your money.
Absolutely. Kate, the big thing that people struggle with is the first investment. So what advice would you have for them?
The biggest thing I would do if I'm getting started with share investing is open a brokerage account and start with something I know, and start really small. So sometimes it's just you need to get your foot in the water. I don't know why I said foot, but your toes in the water to get started with investing. And you might not want to jump straight into ETFs. A lot of people, as you said, want to start with something a bit interesting to pique their interest while they're learning about share investing. And so maybe you'll buy $50 of a company you use and love. And that's your very first starting point. And from there, you go on your learning journey. We have so many free courses on what shares are, how to invest in shares. You've just made your Value Investor program, our previous edition, free. So we'll link that in the show notes as well. But it's going to take you years. And you've spoken about on the show before, it's an apprenticeship. You don't know everything about share investing after a day, a month, or a year, despite what a TikToker will tell you. You can't just figure it out overnight by looking at one single chart.
Yeah, I spoke to an investor this morning, and he's, a fully mature adult male who's been in the business and career world for over 25 years. And he was saying to me, I only started investing my own money in Australia 3 or 4 years ago. And I don't really know what I'm doing. I understand he migrated to Australia. He said, I understand what I was doing back home, but here I don't get it. The companies are different, the regulations different, how things are presented is different. And like he wanted to invest with us. And he was just like, I can stick with that, but this is just new to me. And he was a few years in, and he made that acknowledgement. And I think that's kind of the key thing is you don't learn everything in a textbook or by listening to this podcast. You've actually you have to put some money on the line.
Yeah.
And different when you and I started. When we started, you had to have a minimum of $500 to start. The beautiful thing through these like micro investing platforms is that you can put like $10, $50 in. Like Sharesies allows 1 cent. So you can put the minimum amount of money in and just figure it out. And you don't have to stay with that investment platform. That's another thing that people get confused about. They think, which brokerage platform? Well, if it's only $500, who cares? Just pick one and see what it's like. And if you don't like it, take the money out and go to another one. It's going to be minimal impact on your taxes. It's going to be minimal impact on your fees. Just try it and see what happens. And now like it gets to the point where you might have 3 different accounts for 3 different things. I would say getting started builds confidence. That's one thing I learned from you actually over the years, and a lot of the research that you did for your book was how do you get confidence? How do you do that? And one of the ways is to do something.
Yeah.
And we have a lot of people that listen to this for years, this podcast, and don't actually do it. But it's okay. You can do it. Feel free. We have heaps of guides, heaps of courses, and tens, if not hundreds of thousands of other people that cross the Rask network every month who are in a similar boat and had that same experience when they started. So get started. Small bits, lots of times. Okay, Kate, so we are talking about some of the lessons that we've learned from 10 years investing in shares. Before we get into the next lesson, I want to ask you, what's the longest share investment you've ever had?
Does it have to be an individual share?
Could be anything.
Well, I think it's my international managed fund that I've been contributing to a small amount on a monthly basis since about 2017.
So that's nearly 6 or 7 years up by my recollection.
Yeah.
So an international managed fund, so a managed fund rather than an individual share. So you send that money through BPay or something every month.
Yep. And a team of analysts pick the individual shares that they're going to put into their fund. So a little bit different to an ETF. There's a lot more research and thought involved.
Yep.
I mean, hopefully it's good.
Yeah, no, that's good. Well, you've held it for this long.
Yeah. So in that case, I researched the fund, I looked at their holdings, and I looked at the management team and their skills and what they were interested in and the direction they were taking the fund, rather than looking at an individual company and looking at their management team, their moat, what their products and services were, their financials, etc.
Yep. That's great. Well, my investment, Kate, I was just trying to figure this out. Some people will know this. My longest running individual share investment now is a company called Pro Medicus, which, blessed be the ASX overlords, that is, over the last 10 years, the most successful Australian share of all 2,300 that happen to be on the stock market. So we originally had an investment service, and we called it Rask Invest. And that was the original membership service. And the very first recommendation I ever gave to our community was a little old medical company called Pro Medicus, which trades under the ticker symbol PME. You can look up the stock symbol yourself and the share price chart.
How long have you owned that for now?
Well, that recommendation, I think, was 2017 off the top of my head. I don't know exactly. I think that's when it was. It was around that time. I remember the recommendation for our members was $7.45 a share.
And then you purchased it at that time as well?
So we have a rule that if we make a recommendation at Rask, we're not allowed to make an investment before our community, which is it just seems to make sense. You put your clients first. So I ended up paying around about $7.70, I think. I could go into my broker and have a look. But I just checked at the time of recording, it's $169.03. Now, this is not at all a recommendation because it is very expensive when it comes to conventional share investing metrics. But I can share a lesson from this.
I'm just imagining the capital gains tax you're going to have to pay when you sell that one day.
Oh, yeah, absolutely. Well, it does pay fully franked dividends. And we have had the CEO and co-founder, Sam Huppert, on the show, the Australian Investors Podcast. So I'd encourage you to go check that out. Every time I look at Pro Medicus, I think this thing is overvalued. I remember it wasn't that long ago. In fact, it was this year that it hit $100 a share. Now it's $169 and it's only, 8-9 months later? I thought it was expensive at $100. So this is a really interesting thing. There's a fantastic book that's come out recently by John Addis, the founder of Intelligent Investor. It's called How Not to Lose $1 Million, I believe. And it talks about all of the mistakes they've had through 25 years of individual share investing on the ASX. If you like this episode, you probably love the book. And what I've realized is that a lot of the companies that I've always bought, so companies like Pro Medicus, Xero, Apple was my biggest single dollar value investment of all time. These types of companies, everyone knows those names. Apple and Xero is the accounting software for those that don't know. Those companies are very well known and they've got very good brands and they're almost never, quote unquote, cheap. They never look like the ones that have the big dividend yields. You don't see them with a lot of red numbers next to them. And my kind of take on this, Kate, my lesson that I've learned is that over the long term, if you are an individual share investor, the number one thing that you should look at is the company, not the share price. Look at the company, its products, its services, who runs it, how well it's doing financially. The share price is guesswork in the short term. And there's heaps of data on this. One of the charts that I wish I saw earlier, one of the pieces of research that I wish I saw earlier than I did was something from the Boston Consulting Group, which I've talked about on Rask Live. It shows that it's only after the 5th year that the sales and the profit of a company become the determining factors of that company's stock price. So after 5 years, people think that they might buy a stock, it goes up. It's because the company did well. That's just a change in sentiment. That's just random. It takes 5 years to know if your company is a good company. That's the key takeaway from that lesson. So
Have you found the next Pro Medicus? I think the people want to know.
Well, obviously, Pro Medicus is there's a really good way of thinking about this. It's like, obviously, so Pro Medicus is up 13,000% plus dividends. It would have to be up. Let's just say, for the other math people in the room, it's approximately a squillion % since it was on the ASX. So that's how much the shares are up. It is one of the best performing shares in the world, right? That does not happen many times in your life. From all of the best investors that I've ever interviewed and followed, they say you might get 2 or 3 of them in your life. There's a guy in the US called David Gardner, who I know you know, co-founder of the Motley Fool. He's one of those investors who found a disproportionate amount of those types of companies. I don't know if I've found the next one, but, one thing that I've learned over the years, particularly with a lot of these smaller companies when they start out, is that if you pick 10 of these companies, these riskier companies, typically only 1 or 2 will be the ones that make up for all the others. And this is actually a lesson in John Addis's book, which I mentioned before, is that if you find those great companies, you want to hold on to them. And it's easier said than done because they are so rare. They are so rare. And typically, I wish I knew this earlier, I was always fearful of losing money. And what I realized is that if you pick individual shares, the thing that you will have to get comfortable with is losing money. You will have to get comfortable with that.
We've both had companies that have completely collapsed and we've lost all our money.
Yes. That is rarer than it sounds because you typically sell out before that happens, like long before that happens. I've only probably had 1 of those in my life and I never stuck around. I sold out. But the key thing is shares can only fall 100%, but they can go up way more than 100%. The key thing that people don't understand about this, and the reason why it doesn't work for a lot of investors, is because people are too scared to hold on. If I had not even $1, a nickel for every time someone told me to sell out of Pro Medicus because it was overvalued, I still own the shares for disclosure. Not all of them, but I still own them. I would never have been sitting on, 22 times my money. Never.
Yeah. It's hard to stay invested.
Exactly what Glenn said, right?
Yeah.
So that's the point. So that's one big lesson. Well, there's a few in there, but what else have you got?
My lesson, and I'll read something out to you, which I'm keen to get your thoughts on after I share this, is that in the short term, it's hard to know if you're any good at share investing. Now, so much of short-term market movements are driven just by how investors are feeling, what's happening in the economy right now, not by, as you said, whether the company's actually producing great results. And so it's very easy in the short term to think that you're really great at investing just because you put money in last month and the company's up 10%. And you can go, hey, I'm a great investor. I should put more money in this company, or I should put all of my money into individual shares. And it's not often until the market falls that you realize, oh, maybe I don't know as much as I thought. And there's often periods such as after the 2020 COVID crash where everyone's investments just rose together and you could have put money in nearly any company and it went up because everyone benefited from that post-crash recovery. And so this is the thing I wanted to read you from Nick Majuli. And we've had him on the show before, but he wrote the case for why you shouldn't pick individual stocks, which is kind of like the opposite of what we're talking about today, but I think it's worth considering.
Definitely.
And you can let me know what you think, whether you disagree. He said, I stopped picking individual stocks years ago, and I recommend that you do the same. But today I'm not going to give you the traditional argument as to why you shouldn't pick individual stocks, but a new one. The traditional argument, which you've probably heard many times before, goes as follows. Since most people, even the professionals, can't beat the index, you shouldn't bother trying. Instead, I'm going to argue that you shouldn't pick stocks because of the existential dilemma of doing so. The existential dilemma is simple. How do you know if you're good at picking individual stocks? In most domains, the amount of time it takes to judge whether someone has skill in that domain is relatively short. And then he goes on to say, well, it takes 10 plus years to find out if you're any good at picking individual stocks, and therefore most people shouldn't even bother trying. What do you think?
Well, I think most people never know, and most people, even the people, the irony of this is the people that are most confident in their ability to pick stocks are the ones, in my experience that are least likely to track their portfolio. It's kind of like the property investors who say, oh yeah, we bought it for 500,000, sold it for 600. And I instantly think, yeah, but you paid stamp duty, you put $70,000 into the reno and about 3 months of your life and you lost your partner because you guys broke up.
Yeah.
I'm like, that is not a profit to me. That is the opposite of a profit because people don't like to check. And you can do it so easily. You use a tool like Navexa or ShareSite and they track your portfolio for a tax as well. So you get performance and you get the tax reporting that you just hand to your accountant or just do it through your own tax return.
And you can compare your portfolio to an index like the ASX 200 and see whether you would have been better off putting it just in a simple ETF.
Yeah, and that's why you referenced it earlier on. I always said that investing is apprenticeship, and apprenticeship typically takes 3 or 4 years. So I think that that's kind of the window that you need to learn enough to know your limitations, to know what you're interested in, and then to decide using the track record that you get from one of those tools to determine if you should just put your money in an index fund and get on with life, or if you should pay someone else to do it. You know, a lot of people ask me, Kate, well, why do you manage a portfolio of ETFs? Like, why would I pay you to do that? And it's actually for that behavioral element. It's because people pay us to do it to help them getting emotional and avoiding the common mistakes. Because we're managing it professionally, it's a different approach, and the fee is bugger all. So that's why we exist. And a lot of older people tend to gravitate towards that because they realize their balances are bigger and they need to do something about it, and they haven't historically tracked. So what I would say is I agree with Nick here in that most people probably shouldn't pick individual stocks, Kate. Most people, if they do pick individual stocks, should have it as a satellite allocation, which we've done a lot of good episodes around. Have 80% of your investment portfolio either outsourced or in ETFs. And then the 20%, if you're really passionate, that's how you can hone your craft. Track that using one of those tools. Because after 3 years, you might actually realize, Kate, that you are better than the stock market and you can do better than the stock market, in which case you should pursue individual stocks, right? That's what it would suggest, particularly if you're passionate about it. A lot of the data that people have, like say what Nick referenced here, is he said the traditional argument is that people, even the professionals, can't do better than an index. But what most people argue for when they say just invest in ETFs, what they're arguing about is they go to something called the SPIVA report, SPIVA, which shows that active fund managers, the people who you pay, like your international fund, by the way, they say that those people will do worse than just the broad stock market. So why would you pay them more to do something that gets you less? But what that means is you're comparing an investment in a professional firm and determining that you should invest in ETFs. You're not comparing your own returns. That's the key difference. You as an individual investor actually have advantages versus the professionals. A lot of the reasons why active fund managers do worse, in my opinion, has nothing to do with their ability to pick stocks, but everything to do with them trying to run a business and make as much money as they can for themselves.
Yes, and they have investors asking for updates every month. They've got investors saying, why are you invested in this and not that? They've got investors that are judging them based off their short-term performance, not their long-term performance.
Exactly. That's why I believe investors like Warren Buffett did so well and do so well, is because there's no one telling him what to do. He's investing it like it's his own money. And that's the big difference. And so I think if I wouldn't use that report of active versus passive and all those types of arguments that people make. What I would do is just get you to track your own portfolio. And until you know that you are better than average, just be guided by whatever results you can actually track.
Yes. And if you can try share investing while you're younger, whether that's in your 20s, 30s, and 40s, try it with a small amount of money. Maybe you put $500 in 5 different companies that you've researched and track your performance, see how you go, see how you deal with the swings. Because if a company that you invest $500 in goes down 20%, that's not going to sting too much. But if you've put $50,000 in one individual company and it goes down 20%, well, that's feeling a lot more painful.
Absolutely, it is. And I think one of the reasons, another lesson, is that a lot of people, Kate, don't have any process that they follow.
Yeah.
So Annie Duke talked about this in her book, How to Decide. And I know you've read the book. You handed it to me and I crumped up all the pages and made it look all like it's been 20 years old. So thanks for the book. But seriously, she talks about this. She talks about this idea called resulting, which is the idea that people judge the quality of their decisions, including investment decisions, based on the result that they get.
Yeah.
So they'll be like, I bought this stock, it went down 10%, therefore bad investor or bad investment, which is completely the wrong thing in order to make a good decision. And she goes through the criteria, and you went through that previously. Even Warren Buffett has a criteria. He said it in 1977, and he says it more in recent years. His criteria is based on 5 key principles. It's very similar to the 5 key principles that we follow at Rask. We'll put a link in the show notes or YouTube description of our investment philosophy. And you'll see it's just 5 quick things that you can run through. What does the company do? Who runs it? Does it have a competitive advantage or a moat, as it's commonly called? Is the company in a growing industry? And what is the company's valuation? It's not necessarily like go really technical and get out 10 spreadsheets, but we have a guide for that. We have things that you can access. We have free courses on how you can hone your craft. The key thing to remember, though, is 1, you're tracking your portfolio, which we just mentioned, using one of those tools. But 2 is you have a process, because if you don't have a process that you're following, even if it's just a basic checklist that's on in your diary, whatever, you won't be able to ever say, I bought this stock for this reason, and this is the reason it didn't do well. Because if you don't do that, you wouldn't know that that's the one thing that went wrong and to fix it next time. So you never get in this cycle of improvement. And that's what clearly all of the best investors in the world have in common, is that they have this curiosity and this fascination for wanting to get better. The reason they read so many books is because they're curious and they want to keep developing their craft. And I think without that, most people wouldn't succeed at all. So have a very simple process. Our courses take you through it, and it's free to learn it, how to build one of these things, and then just track it as you go and get better and better and better and better. That's it.
Where I probably sit now with share investing, because I've gone through the throwing darts at a dartboard. I've gone through trying to learn about small companies. I've gone through having lots of different individual shares and no individual shares. And where I sit now is I have that core ETF portfolio. I've got a few managed funds. I've got my superannuation. And then I'm invested in a handful of individual companies, mostly larger companies now in Australia and the US that I'm interested in. Mm-hmm. And I just stick with a few now because at the end of the day, I don't have time to stay on top of a lot of different companies. I'm studying other things, and investing is not my priority. So I'm not trying to gain an extra edge on someone else. I'm happy to have my money invested in broad ETFs that are investing in Australia and US shares, a handful of shares that I'm interested in and I can stay on top of. And the rest of the time I use for everything else in my life and all of that good stuff. I'm not trying to look at 30 individual companies anymore.
No, you're not. And I think that's probably similar to me in that I've kind of, I wouldn't say necessarily completely changed, or I'm not completely the same, is I probably cleaned up my strategy. And nowadays my strategy is use ETFs for the core and then still have individual stocks, but a much, much, much smaller part of my portfolio. And those stocks, I don't worry about all the details like I used to. I just pick 10 or 20. At the moment, I only have one, which is Pro Medicus, but I'm about to start buying more. I just find 10 to 20 companies that I can own and keep a hold of for as if I'm going to hold them for 10 years. And I think if someone asked me on Twitter about a year ago or 2 years ago, they said, Owen, if you could buy one company and own it for 20 years, what would you buy and why? And I said, the first way to figure this out is not which stock is going to do the best over 20 years. It's which one's going to make it to the finish line, because most companies wouldn't even last 20 years. So the Charlie Munger quote is, it is easier to avoid stupidity than it is to seek brilliance. And I always think about that when it comes to investing. And basically, you'll hear this concept thrown around. It's called anti-fragile. Finding things that don't break. ETFs and index funds don't break. That's one of the reasons they're so good. But there are other types of companies that are also designed through their makeup and through their people and through their culture to not break. And so those types of companies are the types of companies I want to own in that last 10 or 20. And it's not necessarily me saying I think these are the world beaters. These are the companies that I think will still be around and can grow over time and evolve over time. And typically those are companies that are run by families or founders or companies that have multiple different product lines and diversification. Like a company might be like L'Oreal, for example, or LMVH. These types of businesses have multiple portfolios of different products and services and different geographies and with different brand names and different websites and different marketing strategies, all so different, but all kind of united under one company. And that's what makes them so special. So those types of businesses. And I know you and I talked recently about some different charts and different ways of thinking about things. And one of the things that I've realized, and I did this professionally when I did a study on this, is the more investment decisions you make, the harder and the lower the quality of those decisions become. And this is why people always say that simplicity is key in many walks of life, but in investing in particular. One thing that Nick alluded to in that quote that you mentioned before is that if you go down the path of just individual investing, what you're committing yourself to is, let's say you invest in 10 different stocks, some of them do really well, so you keep those stocks. What you're effectively doing, Kate, is you're requiring your future self to monitor that stock. Right? Now, with Pro Medicus, I've held it for that long that I know the company basically inside and out. I could tune in for 2 minutes of the CEO's presentation, having never known what they did in the last 3 years and still understand what they're doing because I know the business so well. That's different to most share investors who have no idea what their company's done. They just buy it based on something they read online. So when it comes to that type of thing, it's just having that deep understanding of what you're doing, but also knowing that, if you do commit to individual investing, like I have with this company, you need to be aware that you're going to have to monitor it. And that's going to involve more decision making. So this is why we say fewer decisions in your core portfolio is just like ETFs. Great plan A or plan B, and then have the fun over to the side, but just know what that entails. So that's how I invest. That's how I kind of make my way through things. I think there's one question we need to ask ourselves to end this episode, Kate.
Do we still think share investing's worth it?
Do you think it's worth it?
I would say so, but I've definitely changed how much it is part of my life. It used to be the only thing I invested in because I didn't know about ETFs back in 2016, but now I do. Share investing is only a small part of my financial future and my current financial portfolio. And it's only a small bit of my time investment as well. But I still think it's worth it, especially if you're curious, you like knowing more about the world, you want to know how things work, and you want to be involved in your own wealth creation.
Yeah, I'd agree with basically everything you said there. I think 90% of people don't need to know the ins and outs of share investing. I think that those 90% of people would be better off just owning a diversified portfolio of ETFs or just getting someone to do it for them. The last 10% of people should approach it not with the view of making money, but as you said, with the view of understanding the world. Because if you view it that way, you will more than likely be successful in it, in my opinion. It's for the people that think trading stocks, quote unquote, trading stocks is the source of wealth. That is a mistake. I think investing and trading are very different things. And for those 10% of people, I would encourage you to self-reflect and ask yourself, am I committed to learning? Is this something that I would do even if there wasn't money involved? And if the answer is yes, then it's probably something that you should pursue because you will understand the world better. You'll understand why people make decisions, why business leaders change the world, why entrepreneurs do certain things, and you'll have a much better grasp of how the world runs. I'm still going to do it long into the future, and I'm not just going to pick individual shares. I'm also going to look at private companies, like local companies that you might have down the street. Like I'd be happy to buy some of them as well. It's not just the companies that you see on the stock exchange. You can buy shares in literally anything, basically. So I think it's still worth it. But for the majority of Australians and the majority of people that listen to this, you can just stick with ETFs or some other type of passive investing, whether it's property or whatever, and just let that do the heavy lifting for you.
And luckily for you, if you're interested in ETF investing, we have a free ETF investing mini series on the podcast. We'll have it linked in the show notes so you can learn everything there is to know about getting started, building a really simple investment portfolio that builds wealth for you and your family. We have a free investing course on Rask Education. And if you want to learn about share investing, we have plenty of resources linked in the show notes as well for you. It's something we've talked about for years. So anything you're interested in, we'll have a resource for you. So if you can't find something you're interested in, send us a message on Instagram or in our Rask community linked in the show notes, and we can probably send a link your way.
Yes, indeed. And we do have, for people that are new to ETF investing, something that you will have to pay for if you want to be part of it is our membership community, which is Rask Core, that helps you pick or helps you find individual ETFs that you can use to build your portfolio. And once you set up your portfolio and you ask us questions about it, you're basically good to go if that's what you want to do. So that's called Rask Core. We'll put a link in the show notes, and it supports Rask if you do that. But Kate, we've covered a lot of ground in this.
We have.
And we're going to link to a lot of resources. So go and check them out. 10 years of share investing. It's been a long 10 years, but also it's been fun.
Yeah.
So you learn a lot in this game called investing, and you learn a lot about yourself as well. So it's been a great journey. I wouldn't take it back for anything. So heaps of fun. Kate, as always, thanks for joining me.
Thanks for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.